Hello and welcome. Today, we're going to dive into a really fascinating research paper from the Bank of Spain. It models what might happen to our economy if we introduced a central bank digital currency, or CBDC. And you know what? The results are probably not what you're expecting. To really get why this is such a hot topic, we've got to start with the one question that's at the absolute heart of this whole debate. I mean, this is the number one concern for pretty much every policymaker out there. If the government offers a perfectly safe digital version of the dollar, why would you keep your money in a commercial bank? What would happen to the entire banking system as we know it? The logic behind the fear seems, well, terrifyingly simple. People looking for the ultimate safe haven for their money would start pulling their savings out of commercial bank deposits and moving them over to this new government-backed digital currency. And if banks suddenly lose their main source of funding, which, let's be honest, is our deposits, they can't make loans anymore. Think about it. No more loans for small businesses, no new mortgages, no car financing. The whole credit system could just grind to a halt. That's the nightmare scenario. So this Bank of Spain paper tackles that exact fear head-on. They built a model of the economy just to see what would actually happen if you introduced a CBDC into the mix. Basically, the researchers created this kind of digital sandbox where you and I can choose between good old-fashioned physical cash, our regular bank deposits, and a brand new CBDC. Now, the crucial thing here is that the model assumes we don't treat all of these as perfectly interchangeable, right? We value them for different reasons. So what did the model predict? Well, when people start using a CBDC, that money has to come from somewhere. And the analysis shows that the vast majority of it, we're talking about 3/4, would come directly out of our traditional bank deposits. Only about 1/4 would come from the physical cash we have lying around. Okay, so that deposit crunch is real. The model confirms that people do pull money from banks. But, and this is a big but, the paper reveals something completely counterintuitive about what happens next. Right, let's dig into this because it's the core of the whole paper. Even with a massive drain in deposits, the model shows that bank lending doesn't just stop. So why not? What's the secret ingredient here? Well, the answer is something called bank reserves. The best way to think about these is like a giant reservoir of cash for the entire financial system. It's money that commercial banks hold in their own account at the central bank. And right now, in most advanced economies, we operate in what's known as a floor system. Now, that's a fancy term, but all it really means is that central banks are deliberately keeping that reservoir overflowing with trillions of dollars in extra cash. So here's the key takeaway. When you or I pull deposits from our bank, the first thing that drains away isn't the bank's ability to lend. No, it's this giant overflowing reservoir of excess reserves that gets tapped first. The system has this massive built-in shock absorber. But as more and more people adopt a CBDC, this draining of the reservoir starts to fundamentally change the actual plumbing of monetary policy. It pushes the whole system through 3 very distinct phases. The system starts out in the floor system we have today, where that reservoir is full to the brim. But as the CBDC drains it, it transitions to a corridor system, where cash suddenly becomes scarce. And in an extreme case, it could even hit a ceiling system, where banks are basically having to borrow from the central bank constantly just to operate. And right here, you can really see that core finding in action. Look at this. As people adopt the CBDC, notice what shrinks dramatically. That green segment, the reserves. But look at what stays remarkably stable. The blue segment, that's the lending to the real economy. The shock gets absorbed before it can do any real damage. So, after all that, what is the total damage to the economy? Well, this is the number the model spits out, negative 0.3%. Just let that sink in for a second. What that means is for a huge, massive CBDC adoption, one that's equivalent to 20% of the entire economy's yearly output, the predicted hit to GDP is just a tiny fraction of a percent. The economic earthquake everyone was afraid of, it turns out to be more like a tiny tremor. So if a credit crunch isn't the big problem, then why is there any negative impact on the economy at all? I mean, where does that little 0.3% drop even come from? Well, the model suggests that this small economic drag doesn't actually come from banks being unable to lend. Instead, it comes from a really subtle change in our behavior as households. Here's the logic. The new CBDC in this model doesn't pay you any interest. So when people shift money into it, the average return they get on all their cash and savings goes down just a little bit. This creates a slightly weaker incentive to save, which over the long run means a little less investment and a marginally smaller economy. And this just brilliantly illustrates a key policy choice that's on the table. The paper shows that if the central bank actually designed the CBDC to pay a certain rate of interest, this small negative effect on GDP could be almost completely wiped out, at least as long as the financial system still has plenty of reserves. The paper even finds this fascinating little twist in how we might get there. Just the announcement of a CBDC that doesn't pay interest could lead to a small drop in long-term inflation. And this, paradoxically, makes physical cash more attractive in the short term, leading to this weird, temporary surge in demand for banknotes before they're eventually replaced. So the real story of a CBDC, at least according to this particular model, isn't some dramatic collapse of the banking system. It's a quiet, fundamental, behind-the-scenes shift in the operational plumbing of the entire financial system. Which really leaves us with a final thought. If the system can actually absorb the economic shock, is the real debate we should be having not about a credit crunch, but about the long-term consequences of rewriting the central bank's rulebook and concentrating so much power over the financial system under its direct control?